Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're here to talk about long-term options, leap options, as a stock replacement strategy. Now, this webinar is designed more so for those of you that are more longer-term investors, either in stocks or ETFs. Anything that's optionable, if you invest in those for the long term, you should consider taking a look at options as an alternative to the stocks that you own. Now, this is not necessarily suitable for every long-term investment. So today we're here to discuss what leaps are, when should you utilize it, so that you can understand what the benefits are and decide for yourself which one's better suited for you. So I'll take a little bit of time to break down these options. They're fairly simple to understand, but I want to talk about what you should expect when you're trading leaps, what type of outcomes you should expect, and what are best practices for choosing the right expiration date and strike price so that you can understand whether they're suitable for you. And more importantly, I want to make sure that we show you how to utilize options play to analyze them and go through a few different examples so that you can become self-sufficient in utilizing the tool to be able to analyze these trades on your own. So let's go ahead and get started. Before I do, just a bit of housekeeping. For those of you that are brand new to Options Play, welcome. You can sign up for a free 30-day trial to this tool that I'll be showing you here today using this link here below. After your 30-day trial, membership is just $75 a month or $500 a year. And this gives you access to a free 12-step options trading course to help you jumpstart your options trading for those of you that are relatively new, and daily options trading ideas delivered to your inbox every single day, in addition to the platform and the education that you receive, such as the webinars that you're on right now. So with that, let's go ahead and get started. What I'm going to talk about first here is what are leaps? What are we referring to when we call these leap options? When should you utilize them? Meaning, what type of scenarios should you even consider utilizing leap options? Then we'll talk a little bit about what are the optimal leaps, meaning what expirations, what strike price makes sense for these long-term investments. And lastly, we'll talk about some of the tips that we have regarding trading leaps, things that you should look out for, and talk a little bit about what a strategy called the poor man's cover call. The goal here today is to really help those of you that are long-term investors seek another way to gain upside exposure in the stocks that you want to invest in, or stocks or ETFs that you want to invest in the long run, but do it in a way that's perhaps more capital efficient, meaning require less capital to enter the trade, reduce your risk a little on those specific trades. So with that, let's go ahead and get started. Now, before I do, I just want to launch a quick poll here. How many of you invest in stocks or ETFs in the long run? And when I say invest, I mean you buy and hold onto those stocks. So please answer the poll on your screen to get a sense for what we see here on them. Now, can everyone hear me? Okay. Can everyone see the poll that's on your screen? Okay. So let's scrap the poll here then. Let's do a quick, can everyone please bring up your chat window? If you invest in stocks or ETFs in the long run, please type 1. If you do not invest in stocks or ETFs in the long run, please type 2 into the chat window, just so I can get a sense for the audience here in the room. Okay, so I see a few 1s, a couple of 2s as well. So just to be clear, this webinar is for those of you that are investors in stocks or ETFs. Now, I just want to make sure, can everyone hear me loud and clear? If you can, please type yes into the chat window. Okay, good. I just want to make sure everyone can hear me. Great. I'm wondering if anyone has any issues with hearing me. Okay. Looks like people can hear me, so let's go ahead and let's continue. So uh, let's start with what are leap options. Number one, leap options are really, really simple to understand because they are just call and put options. So if you understand what a call or a put is, you will understand what a leap is. A leap is simply just a call or put option that expires more than 9 months from today. That's all they are. They're just options that expire a long time from today. And there are two types of leaps you can trade, a call and a put. A call option is bullish, as many of you are familiar with. A put option is bearish. And a call option, and both of these strategies give you what we consider unlimited upside or downside exposure. Just like when you buy or short a stock, as long as the stock keeps going higher and higher, when you buy it, you'll make more and more money. Or if you short a stock, as long as the stock keeps going lower and lower all the way down to zero, you'll keep making more and more money. Now, the benefit of trading a leap option or an option in general compared to buying a stock is the fact that you have what's considered limited downside, meaning no matter what happens, the most you can risk is the premium that you pay for either that call or put option. So the benefit of trading these options is so that you can get unlimited exposure to the upside, so that the stock keeps going higher and higher, you're able to participate in it. But to the downside, you have limited exposure. Vice versa, if you're shorting a stock, you want this unlimited downside exposure, but when you short a stock, you truly have unlimited risk, and you don't want to take that on necessarily. So by buying a put option, you're still able to take advantage of that unlimited downside if the stock keeps going down lower and lower, but you have limited amounts of risk on the overall trade. Now, if that makes sense, everyone, please type 2 into the chat window if the concept of just a leap option is simply just a call or a put that expires at least 9 months from today, but the trade itself is exactly the same as a regular call or put that you would purchase. Great. I see a lot of 2s. Perfect. So sounds like everyone, generally speaking, understands what a leap option is. So let's move on. Let's talk about when should you actually consider using a leap. Number one, a leap is simply a replacement strategy for a long stock position. And this only makes sense, meaning it only makes sense to consider trading leaps when you have a bullish outlook on a stock that you plan on holding on to for at least 2 to 3 months out. So this is for many of you that are more fundamental investors. You invest in the long run, and you want to make sure that you have the time horizon that's longer, meaning this is not for those of you that are trying to trade a relatively short move that might last a few days, even a few weeks, may be too short for using a leap, meaning if you have a shorter term outlook, you should use a shorter term option to match it. Now, I would say the biggest reason that you should consider using a leap option compared to just buying a stock is many times to mitigate downside risks. Now, one of the questions I wanted to ask at the very beginning through a poll, but the poll's not really working right now, is how many of you, for those of you that are investors in the long run, how many of you believe that stocks will be higher one year from today? Meaning, how many of you believe the markets will be higher than where it is today 1 year from today? If you believe that, please type yes. If you believe that the markets will be lower, please type no. I just want to get a sense for the audience here in the room. How many people believe markets will be higher 1 year from today? And how many believe markets will be lower 1 year from today? Either a yes or a no. So I think we have a pretty diverse group of answers here. A lot of yeses, but also quite a few nos. And on the flip side, how many of you feel that a recession will be coming in the next 2 years, a yes or a no? Seems like a few more yeses this time for users who believe that there's going to be a recession in the next couple of years. So I think this is good. Based on the response for whether you believe markets are going to be higher or lower, there seems to be a very mixed bag of answers, which is normal when we've had a 10-year bull run. I personally am in the camp that I believe markets will be higher 1 year from today. However, I do see the increasing risks of a recession coming on, which is one of the reasons why we want to consider using leap options, because we still want upside exposure because we believe the markets are going to keep moving higher, but we do see elevated risks of a correction. So one of the ways that we want to protect ourselves against that correction is by using an option, because an option allows us to participate in that upside while maintaining a limited exposure to the downside. And there are other reasons that you might want to mitigate downside risk. Sometimes going into earnings. Maybe you want to buy a stock that's very volatile and they've had a history of maybe missing earnings and having a big move to the downside, but you think that there's a possibility that they will beat earnings, so you want to take that asymmetrical risk. That's one reason why you might want to use a leap. Other times you just want to buy a stock that's a little overbought or extended. Look at Apple. Apple's made this huge run over the last couple of weeks and a couple of months, but maybe you still think the stock is going to continue running. You think it's at 250, you think it's still going to go to 300, but you are concerned that maybe there is a slowdown. Maybe China causes Apple to come down. So you want to invest in the long run, but you are concerned about the fact that things are overbought, they're a little extended, and you want to mitigate that downside risk. Those are reasons why you want to use a leap option as opposed to outright buying the stock. Conversely, on the put side, this is less so used for a bearish outlook. Usually we tend to see bearish puts or leap options used more so to hedge a stock or a portfolio of stocks. And this is generally used for when you have a bearish outlook on the market 1 to 2 months out. So this is for maybe for those of you that believe that markets will be lower 1 year from today, and you believe there's going to be a recession coming in the next 2 years, you might want to buy some put leaps on the stocks that you own or to hedge your portfolio. That's when you might want to consider using put leap options. So those are the different scenarios that you might find yourself in where you might want to use leap options. So now what I want to do is I want to go through a couple of examples just to show you, and really the best thing to do is compare a stock to an option to give you a sense for how they perform. So let's say I have stock XYZ, it's currently trading at $100, and I have a bullish outlook on that stock. I believe the stock is going to rise higher. So as a stock investor, I would simply buy the stock, and an example of this is I would buy 100 shares of the stock at $100 a share. And what this gives me is unlimited reward, meaning as long as the stock continues to move higher and higher, I'm going to make more and more money on this underlying stock. Now, however, when I buy 100 shares of the stock at $100, what I'm risking is $100 a share. So my max risk is $100 a share, but I can participate in unlimited upsides as long as the stock moves higher and higher. Conversely, if I bought a leap option, now what I'm going to do here as an example is, let's say I buy a September 2020, which is roughly 1 year from today, and let's say I buy an $85 call option. Now this is an option that's already in the money, and I'm going to discuss in a few slides why I'm buying an in the money slide. But for argument's sake, let's say I buy this 1 year leap option that's in the money, and let's say it cost me $25 to buy this call option. Now, remember, this option is already $15 in the money because the stock is at $100. I'm buying an $85 call option. Even though it cost me $25, it's already $15 in the money. I'm really only paying $10 in time value for this 1 year. And what this also provides me with is unlimited upside. So when I buy a call option, I get unlimited upside if the stock keeps going higher and higher. But as you can see, my max risk is only $25 a share, which is a quarter of what I'm risking when I buy 100 shares of that stock. And that's really what I'm looking for, is unlimited upside at a fraction of the cost it would take me, or a fraction of the capital outlay it would require to control 100 shares. So what you get with this leap option is, number one, you get reduced risk because my risk goes from 100 to 25, and it reduces my cost to get into the trade. This also at the same time allows me to maintain this unlimited upside exposure that I'm looking for when I buy a stock. Now, if this makes sense to everyone, please type 3 into the chat window. I just want to make sure everyone understands this concept before I move on to the next example. Okay, great. Looks like a lot of people are, I see a bunch of threes, which is great. So now, if that makes sense, everyone, I think the next one is going to be a really easy slide. Let's say I have a bearish view on stock XYZ. I believe this stock is going to plummet. So what are my options as an equity investor? I can short a stock. So let's say I short 100 shares of the stock at $100 a share. My max reward is $100 a share. What that means is that if the stock goes all the way down to zero, I'm going to make $100 a share if the stock goes down to $0 a share. Unlikely, but if it does, I make $100 a share. Now, the downside of shorting a stock is that you truly have unlimited risk, because if the stock takes off, if instead of going to zero, it ends up going to 200, the higher it goes, the more money I lose, and I do not want to be in that position. This is not a good position for anyone to be in, to have unlimited risk. So the better option here is to buy a leap option. So here I'm going to do the same thing. I'm going to buy September 2020, which is 1 year from today, and I'm going to buy a 115 put. Again, I'm going to buy an in-the-money put, and I'm going to explain why I do this in a few slides. Let's say I pay $25 for this put, which is, again, already $15 in the money, so I'm really only paying $10 in time premium on this put option. Now, what this does, because I pay $10 in time value, my maximum reward on this trade is, instead of $100 a share, is now only $90 a share, because the difference between 115 and 25 is $90 a share. So if the stock goes to zero, I make $90 a share as opposed to $100 a share. But my risk here is capped at the $25 that I pay for the option. And that is the biggest difference between shorting a stock and buying a put, is the fact that one has truly unlimited risk. The other one caps my risk at just $25 a share. So this allows me to predominantly mitigate this unlimited risk while maintaining similar unlimited downside exposure as shorting the stock. And that's the primary benefit of why you want to buy a put option whenever you have a bearish view on the stock. Now, I'll be honest, it doesn't matter whether you have a bearish view that's going to last 1 day or 1 year. It doesn't matter the time frame. If you are bearish on a stock and you're thinking about shorting that stock, you should always consider a put versus shorting the stock. Now, if that makes sense to everyone, please type 4 into the chat window before I move on to the next slide. Just want to make sure everyone understands before we move on. Okay, great. I see a bunch of 4s. Stupendous. So let's get on to the next slide. Now that we've talked about leaps, what they are, we explained when you should utilize them and a couple of examples to look at. Now, just to summarize some of the benefits, number one, you want to have similar exposure to the either buying or shorting the stock, but doing it away with limited risk. And what you want to do is you want to leverage your stock position. So let's say you want 3 to 5 times leverage on your stock position. That's really when the call option or the put option makes more sense. Now, what you really want to do here with a leap option is to allow you to buy that optionality with relatively low time decay. So when we talk about can everyone hear me? Looks like I've got a few things about voice quality issues. If you can hear me, please type yes into the chat window. Everything's good now? Give me 1 second. Let me see if I can fix this. I apologize. Okay, says a few people said it sounds okay now. I'm going to continue, and if it continues to have a problem, please let me know. Or actually, you know what? Let me just try one thing here. I apologize. Let me try one thing. Okay, I'm gonna continue for now. Hopefully this works itself out. Now I want to say, so far I think I've put leaps in the light that it is a great alternative to buying the stock or shorting the stock. However, I want to make sure everyone understands what the limitations are, because there are quite a few. Number one, these options are not as liquid as the front month options. So if you're used to trading 1 month options, 2 month options, those trade all day long. They're very liquid. Bid-ask spreads are usually very tight on most liquid stocks, but the further you go out, the less liquid they are, the less open interest there is, the wider the spreads. So you have to be cognizant of that when you're trading this. So it's not suitable for active trading. If you're going to, this is really only for stocks that you want to buy and hold on to for the long run. That's when you want to utilize a leap option. Second of all, they do not receive dividends. So I asked you, how many of you invest in stocks or ETFs in the long run? Many of you pick your stocks based on the dividend yield because you want a nice income stream on the assets that you own. And that's a perfectly reasonable reason why you own certain stocks or ETFs. But when you buy a call option, you do not receive those dividends. So that is something you should consider if you rely on those dividends as to whether or not you want to buy the stock or if you want to buy the leap option. But I will show you one other strategy that you can generate some yield from these leap options, even on stocks that don't pay a dividend. So that is something we want to cover here today. And third of all, leap options are not available on all stocks or ETFs. However, they are available on a vast number of them. So one of the things is they're available on about 2,500 different stocks, ETFs, or indices. So they do have pretty large coverage. It's just any expiration greater than 9 months out is your starting point. I usually recommend when you're using leaps to trade somewhere between 9 months to about 1.5 years out. I tend to find that if you're going out 2 to 3 years, those really have very wide spreads. You might have a difficult time entering and exiting them from an order perspective. So I don't like to trade leaps that are more than 1 year, 1.5 years from today. So 9 months out to about 1 year is usually the sweet spot that I would typically trade. And the reason for this, again, is that the longer dated options minimize theta. They minimize time decay. Now, when it comes to strike prices, this is really where you have a lot of options. Now, you can buy an at the money, out of the money, in the money. I always advocate that when you're buying these leap options, I tend to find it's better to buy an in the money leap option. So usually about a 60 to 70 delta is a good starting point for a leap option. And the reason for this is because in the money leap options have lower extrinsic value. And that means that you're paying less in time premium. When you're holding on to something for this long, time premium really eats away into your profits, and you want to minimize that time premium. One of the best ways to do that is by buying something that's slightly in the money, because the time premium you're paying is going to be a relatively smaller fraction of the total premium that you're paying. Now, when you use these types of strike prices, you'll typically find that the cost of buying a leap option is usually about 15 to 30% of the underlying stock price. So you're able to control the same notional value as 100 shares for just 15 to 30% of the underlying stock price. So you're getting anywhere from about 3 to 5 times leverage on your money. And you can use this multiple ways. You can either leverage your money, or you can control the same amount of capital for a smaller amount of risk in your total account. And those are the different ways I think you should think about utilizing leap options in your portfolio. So let's go ahead and look at some examples. And I think this helps better understand why I advocate for trading something that's in the money versus trading an out of the money leap option. Because when we're using leaps, again, the goal here is to replicate the stock position that we would take with less risk. And an in the money leap option will much closer replicate the stock position rather than out of the money leap option. Many times it's more like buying a lottery ticket. So what you see here is, let's say you have a $100 stock, and we have a few different scenarios. The stock either moves a little bit lower, or moves significantly lower, or moves a little bit higher, or moves significantly higher. And what you can see is that here's in the first column, I have buying 100 shares of stock. And what I want to do is I want to compare or show you why buying an in the money leap option is what I consider the best strategy to utilize. Because as you can see, almost in all the scenarios, you end up pretty much the same as the stock position. you end up pretty much in the same position as the stock position if when you buy the in-the-money call option. So let's see. When the stock stays exactly the same, I only have a $5 loss on this particular trade. If the stock moves a little lower, hold on. Let me try one thing. It looks like more people are having audio issues.
Welcome to Zoom. Enter your
Okay, I'm now dialed into another line. I hope that that sounds better. If you can hear me loud and clear now, please type yes into the chat window. Okay, sorry about that. I apologize for the audio issues here today. So, as I was saying, the goal of buying this in-the-money leap option is to replicate as close to the stock position as possible, but at the same time, if the stock has a catastrophic loss, meaning if the stock drops 50%, you have limited risk so that no matter what happens, you're limited to the premium that you pay for the stock. So for the leap, because here I'm paying $20 for the in-the-money leap, and I'm only paying $5 for the out-of-the-money leap. Now, many people will say, well, why wouldn't I want to control 100 shares with $5 when I can, for $20 when I can do it for $5? And the reason for it is really because most of the time, what you're going to see is the stock is going to make a relatively small, or I wouldn't say a reasonable move in your direction. And what you want to do is you want to replicate that stock position as much as possible. So as you can see, the gain from the in-the-money leap option and the stock are just $5 apart in all four of these scenarios. And the only time where it outperforms really is when the stock has the catastrophic move to the downside. Versus when you buy the out-of-the-money leap, yes, it's really cheap, but most of the time, you're not really getting the gains that you really want. So when the stock moves 20% higher, you only make 100% gain. That's not really what most people are looking for. You really need a really large move to the upside before you have any significant gains on the out-of-the-money. So as you can see, for the most part, you're basically losing money most of the time, or a small gain, and you only in the position where if you have a very, very large move, do you have that big move to the upside. As opposed to when you buy an in-the-money leap option, you basically are trading at even as the stock leg with just 20% of the underlying capital. So that's really why I advocate that if you're trading a leap option, that you use an in-the-money leap as opposed to buying an at-the-money or out-of-the-money leap, which gives you a very different risk profile, which usually is not suitable for long-term investors because you really need to hit it out of the park in order for that out-of-the-money leap option to make any sense. So if that makes sense to people, please type 4 into the chat window. Okay, great. So let's move on. So let's talk a little bit about trading tips, right? So now that we've talked about leap options, we've gone through a few different examples. I've shown you why it makes sense to use in-the-money leap options. Let's talk a little bit about how should you trade them. Number one, when you're trading a leap option, you really should think about trading a stock. When you're trading a stock, what do? You enter it when you think the stock is going to start a long-term bullish or bearish move. So you want to do the same thing with the leap option, and you want to exit your leap option before expiration. That's one of the key things, is that if you are trading a leap option, you always want to make sure you exit before expiration, either at a gain or a loss. And you generally want to set stop losses based on the underlying stock price. So you should really think about a leap option as just a vehicle for you to trade the stock, but you're simply using the leap option for your trading. But as far as deciding when should you enter and when should you exit, that should be based on your underlying stock, not based on the leap option itself. And what I really want to discuss here today is showing you what's called a poor man's covered call, because this is one way to further reduce your risk on an underlying leap option, because the goal of a leap option is to give you that upside exposure with limited risk, and the poor man's covered call is another way to further reduce your risk. So that's what I want to discuss next, is how do you go about doing that. So a poor man's covered call is really simple. All you're doing is you're doing the same thing you would if you were selling a covered call against a stock position, but now what you're doing is you're replacing that stock position with your leap option. Now, for those of you that have some experience trading options, a poor man's covered call is really just a diagonal. You're buying a long-term leap and then you're selling short-term options against it. Now, the reason that you want to do this is because when you're selling covered calls, generally speaking, in the long run, you're going to average about 2 to 3% per year in income for the of the underlying stock price when you're selling covered calls. Now, because leap options cost significantly less than the stocks that you want to purchase, it only costs you about you can actually receive roughly 10 to 15% of the premium that you receive on a covered leap. Now, the only downside to a poor man's covered call or selling covered calls on a leap option is that you always have to roll the short call. No matter what happens, if the stock goes significantly above the strike price of the short call, you have to buy it back at a loss and sell another covered call instead of allowing the assignment, because you don't actually own the stock. So if you get assigned, you actually have to go out and buy more stock in order to deliver it. Otherwise, you will end up Monday morning short 100 shares of the stock. That's not something you really want. There is the option of exercising your long leap in order to deliver the shares. However, if you do that, you're going to instantly lose all the extrinsic value of your option. And that is not also a scenario that you want to find yourself in. So when you're selling poor man's covered calls, you are at a slightly higher risk of potentially losing out on the extrinsic value of your long leap if you don't have the cash to cover it, buying 100 shares of the stock. But one way you can prevent that is by buying back the covered call before it expires and always rolling it on to the next expiration to avoid that assignment risk. So that's how you go about trading a poor man's covered call. And I think the best way, again, to really learn about this is to go by example. And for those of you that are trading leaps, you might want to take a look at our covered call reports that we send out every single Monday at 10:30 a.m. This is useful for those of you that trade stocks or invest in stocks and you want to sell covered calls, or if you invest in leaps and you want to sell covered calls against it, also a suitable strategy. And you can find that report that we send out every single Monday at this link. If you want to just bookmark that link and have that available for yourself every single Monday, you can look at it and see what the most up-to-date cover calls, expirations, and strikes are. So with that, what I want to do is I want to jump over to options play, and I want to take a look at some examples of leaps. And I think the best way to look at leap examples is to really just show you some trades. Now, I was looking at the S&P 500 today. This is a market that's been very interesting, at least from my perspective. We recently had this double top at 302.5. Finally broke above that just a few days ago. So I think that clears the path potentially for this market to really continue to move higher. There are some catalysts that I think we need to be aware of, but a lot of things have quieted down. Trade wars have quieted down. Brexit has quieted down. We've got our rate cuts. GDP numbers, employment numbers all look pretty strong. Corporate profits this quarter, one of the highest in terms of beats. Even I will say that partially because expectations were so low, but corporate profits are not looking as weak as we thought going into this earnings season. So I think there's a lot of potential for this market to move higher. But like I said, there are a lot of risks. Brexit, trade deal, are still things that to be concerned about, and there's nothing that, in my opinion, might be preventing us from making a big move to the downside. So if you want upside exposure in the stocks, but you want to do it with limited risk, that's really where leap options come into play. So what I'm going to do is I'm going to first look at just looking at the market. What if I want to go long the market, but I am concerned about a correction? How can I go about looking at a leap option? So what I'm going to do is I'm going to modify this December 13th leap call option. I'm going to look at something about a year out from today, which is, let's just look at the October 16th, 2020, which is roughly 1 year from today. And let's say I buy a slightly in the money call option. Let's say I buy a 300 strike call option. Now, traditionally, I might go a little lower, but let's say I go maybe, let's say, to 295. So it cost me $30,000 to buy 100 shares of SPY. To buy an October in the money call option will cost me $2,400. So that's about 7% of the underlying cost. Especially with these ETFs, you can buy upside for very, very cheap, from a very small percentage of the underlying stock. So here it's costing me about 7% roughly to buy 100 shares of, to control 100 shares of SPY. And I don't know what your views are on the markets, but I personally think that on the high end, I don't think markets are really probably going to go to 330 on the high end, in my opinion. That would be a high estimate on my end. And if you look at, bottoms up, where the S&P 500 earnings are, 330 plus, a multiple of 21, 22 times earnings is really where you're going to get to about 330 or so. And, that's the extent that I see the markets. That's kind of my blue sky scenario, but there's also significant risk to the downside. So if the markets do move significantly higher by October 2020 and it moves up to 330, as you can see here, if I'm invested in the market through SPY, I'd be making about a 9% return. Versus if I bought the in the money call option, I make a 45% return. So again, because it only costs me about 7% of the underlying stock to buy 100 shares, that leverage turns my 9% return to about a 45% return. That's what I'm getting from my leverage. And on the flip side, more importantly, let's say markets correct. Let's say markets move significantly lower. Maybe a recession comes in, maybe something with trade wars comes in, and the market dips down to where it was last December, 243, or 234 rather. As you can see, if I bought 100 shares of the stock, I'd lose $6,800. If I bought the in the money call option, $2,400. So I'm risking roughly a third of the money that I would need to buy 100 shares of the stock with if I bought the in the money call option, and I get leverage to the upside. So if I'm right, I make about 5 times more money than if I bought the stock. And if I'm wrong, I'm risking 1/3 as less. And that's really where the benefit of these options allow you to gain that upside exposure, but in the event that things go wrong, you have limited amounts of risk. And that's really where you can utilize these tools to help you determine how much upside do I actually have versus how much downside do I have. And utilizing Options Play's P&L simulator really allows you to understand your risks before you get into a trade. So with that, what I'll do is I'll actually open this up for you guys to submit some symbols, whether you're bullish or bearish on that symbol in the long run. If you could possibly also give me a target price that you have on that symbol, I'm happy to pull that up and show you how to analyze, buying the stock versus buying a leap option and comparing it side by side. So type in any symbols that you like into the chat window, whether you're bullish and bearish on it, and let's take a look. Gil is asking for Tesla. So let's take a look. I think this is an interesting stock, right? Because this is a very volatile stock. And it certainly is something that, if you're investing in, you're concerned about downside. There's a lot of volatility in this particular stock. So Gil believes this stock is going to go to 350. So let's take a look. Buying 100 shares of the stock. Now, this call option will be a little bit more expensive than SPY, but let's take a look at the September 2020. It's currently trading at 314. So let's look at a 300 strike. So $31,000 to buy 100 shares. $6,400 to buy a leap option. That's roughly 1/5 the underlying stock price, right? And Gil believes this stock will go to 350. Now, I will say that might not look very good. So as you can see, by paying $6,400 for a $300 call option has a break-even price of 364. So if you only think the stock's going to go to 350, you're better off buying the stock because the call option is too expensive. It's actually going to lose you money if the stock goes up roughly 35 points or so. So Gil, if you're bullish on Tesla and you think the target price is 350, I suggest you buy the stock because you're going to lose money on the option. The options are too expensive. Mora is bullish on Costco. This is a stock that I love. This is a stock that has really done very well over the last year, and it's a stock that I would personally, consider investing in. Now, Costco only goes out to January 2021, 290. So let's say I'm looking at a 270 call. So again, $3,000 to $30,000 to buy 100 shares, roughly $5,000 to buy an in-the-money call option. So now that's roughly 1/6 of the cost to buy 100 shares. Now, I don't know what your views are on Costco, but this stock is moving pretty high. I think a conservative estimate for a long run here is maybe in the this is January 2021. So I would say, in the 340, 350 range is probably where most people are looking as far as analyst expectations. So you have to adjust your expectations here as to what you're going to receive. So if you see a move up to 350, 17% return on the stock, 67% return on the call, maybe you're not as bullish. Maybe you only think it's going to go to 330. But as you can still see here, even at 330, you're looking at roughly 2.5 times leverage on your position, and vice versa. If the stock does plummet, let's say it goes back down to that 245 level, you're risking $5,000 versus $4,700. So roughly the same amount of risk for what could be potentially double to quadruple the returns if the stock does move into that 330, 350 area. So you have to ask yourself, do you think Costco will end up at 330, 350? If it does, it might make sense to buy the leap. If you don't think it's going to go to 330, maybe you only think it's going to go to 315. If that's the case, you should not buy the leap option. You should buy the stock. So that's what this tool is designed to do. Is it shows you when you can make money, when you can't make money, because you shouldn't just buy a call option because you think it's going to go higher. It has to go higher by a certain amount. And this tool helps you decide how far does it need to go and whether or not this is suitable for you. QQQ is the next one. QQQ, very similar setup to SPY. I would expect almost identical returns to the SPY example that I just showed you. So if I bought a September 2020, slightly in the money, let's say I'm buying a 190 strike, $19,000 to buy 100 shares, $2,000 to buy a 1-year in the money leap option, a little bit more expensive, about 10% of the underlying versus the 7 to 8% we saw in the SPY, because this ETF is a little bit more volatile. Now, I don't know what your outlooks are on QQQ. I actually don't have a particular target price in mind per se, but I think 215 maybe might be a 215, 220 might be an interesting target. If you do see that, as you can see, 11% return on the stock, 47% return on the leap option. Now, 220 might be a little too aggressive, but on a technology heavy index, I don't think that's actually that crazy for it to move 11% over the next year. And on the same token, with these technology-heavy ETFs, I think you have even a higher possibility of a major correction if tech, is to come down. As we have seen some tech names really take a hit this year. Especially the names that aren't very profitable. If Uber starts to trade at significantly lower valuations, and some of these tech names in a response do the same, as you can see here, you are looking at less risk from the leap option as you do from the stock. Let's look at CVS. CVS, a healthcare. It's in the healthcare sector, but I think this is more of of a consumer staple, consumer discretionary play. But let's just say you were bullish on this stock. Healthcare is certainly one of the stronger sectors right now. Let's say you buy this January 2021, maybe a $60 call option. So $6,600 to buy 100 shares, $1,100 to buy a leap option, roughly 1/6 of the cost. Let's say you think the stock's going to make it back up to that $80 52-week high. Look at that, a 20% return, a big return on the stock, a 20% return in 1 year. That's a phenomenal return on the stock. But as you can see, that leap option gives you an 80% return. So for 1/6 of the capital outlay, you can get a roughly 4x on your capital if the trade does go in your favor, and vice versa. If the trade pulls back to that low here, maybe $53, here you're risking $1,300, here you're risking $1,100. Not a huge difference, but the upside is there. So what you're really getting is perhaps similar downside, but far better upside if you are correct. So if you're incorrect, you don't lose any more money from that leap option, but if you are correct, you make significantly more. The only place where this really underperforms is the stock doesn't move. But as you can see, this is one of the reasons why I advocate buying an in-the-money leap option. Because if let's say you bought the at-the-money leap option, which many people do, if you bought the at-the-money leap option, which costs you just $700 instead of $1,100, this is what happens if the stock doesn't move, right? Because a lot of times the stock doesn't go in the direction that you expect it to, and maybe it just stays the same. As you can see, even though this cost me less money, $700 versus $1,100, I lose more money if the stock doesn't move. So I lose $700 as opposed to only $471. And this is, again, why I advocate for buying something that's in the money versus out of the money. You're not saving much here, but if the stock doesn't move, you'll actually lose less money. I'll do two more examples here. Surinder, Boeing. You have a pretty bullish view on Boeing. You think it's going to go to 420. So let's take a look at that. I don't know how many people share your views. Maybe you're long the stock and you're bullish on the stock. So let's take a look. Let's take a look at December 2020 or September 2020. We'll buy, let's say, a 310 or 300 strike. So $34,000 to buy 100 shares, $6,200 to buy a leap option, roughly 1/5 of that. And just for argument's sake, let me show you what it looks like to buy an at-the-money leap option. So that's September 340 call instead. So $34,000, $6,200, $3,900. So you're saving, another $2,000 or so to buy the at-the-money. And let's say the stock moves to 420, which is what you're expecting. 23% return on the stock, that's a great return, versus 93 versus 104% return. So notice how the returns between these two, relatively similar in my opinion, even though this costs you $2,000 less. You're not making a significantly higher return in my opinion in this particular case, even when the stock makes a big move. But let's say the stock doesn't move. Let's say it stays around 340. This is where I think you're going to see the biggest difference here. So here I lose $2,200 versus here I lose $3,900. So I lose everything if the stock doesn't move, and that's the risk that you take with an at-the-money leap. And I personally don't like taking on that kind of risk, because if the stock just doesn't move, I don't want to risk that much, because I'm paying so much more in time premium with the at-the-money versus here I'm only paying roughly $2,000 in time premium versus here I'm paying $4,000 in time premium. And then vice versa, if the stock does decline significantly, and I think that's a huge risk in the stock like this, depending on where the max issue ends up. Let's say it goes to 290 or even lower, 270. Here I'm losing $7,000 versus 62 versus 42. So this is really where the only place this at-the-money trade shines. However, I will say, if this trade goes, down to let's just say it goes down to 300. By the middle of next year, let's say by March, or the beginning of next year, the max looks really bleak. You think things are going to continue moving lower. The difference between the in the money and at the money is not that big. It's less than $1,000 difference between the two. you might want to just pull the plug at that time because maybe you're no longer bullish on Boeing. You no longer think it's going to go to 420. So you have the opportunity to pull the plug early without risking significantly more money. You're only risking significantly more money if you hold it all the way through expiration. So I hope that this was able to show you guys, what a leap option looks like, why you should consider utilizing it when you're thinking about a long-term investment in a stock or an ETF, and more importantly, why I think it's important to use an in-the-money leap option versus an at-the-money leap option. So with that, I want to thank everyone for taking the time out here this afternoon. I want to thank everyone for providing your inputs and your symbols for us to take a look at. I hope that this was useful in helping you and showing you how powerful this tool is in being able to quickly put in any expiration and strike price and be able to quickly analyze the difference between the stock versus an in-the-money versus at-the-money leap option, and show you how you can do this analysis yourself and get a sense for whether you should trade the stock or a leap option. So with that, what I'm going to do is I'm going to open this up for a Q&A. I know there were a few questions already asked here. I apologize for the sound issues we had in the middle. I hope that that was resolved at the end. So let's take a look at some of the questions that I have here. But if you have more questions, please type them into the chat window, and I will answer as many questions as I have time for here. And just to remind you, for those of you that are not members yet, I hope that you consider supporting us and becoming a member so that you can see our daily trade ideas that we put out, come to our weekly options education webinars like the one that you're on here, have access to our weekly cover call and short put scans that we email to everyone on Monday mornings, and just access to the whole options play software suite so that you can do the same analysis that I'm showing you here today. So please, if you have any questions, please type them into the chat window and I will answer as many questions as I have time for here today. So looks like Tony asked this question. At the money is less capital, less loss if against you, and higher return if going your way. The only issue is stagnant, just lost some of that time decay. So Tony, from my perspective, what I really care about is not necessarily how much it costs, because I'm already saving, I'm going from $34,000 down to $6,000. So an additional $2,000 doesn't make that big of a difference, but what makes the biggest difference is the fact that, here I'm paying $2,200 in time premium. Here I'm paying $3,900 in time premium. I'm paying double in time premium. Time premium is what works against you when you're long an option. You want to reduce that as much as possible, and the best way to do that is to buy something slightly in the money. You don't have to go as deep in the money as I do. Maybe you want to go maybe a 310, but still you want to reduce the time premium that you're paying, not just the capital outlay, because you're already reducing the capital outlay by a significant amount, going from 34,000 to 5,500. So going from 34,000 to 3,900, that impact is not as large. But this at the money option pays double the time premium, and that's what I want to reduce. So I hope that that was able to show you why it makes more sense to buy the in the money versus at the money. Let's see. Jake is saying, what is cover call you sell on VA in this particular case? I would sell the same cover call that I would if I owned the stock, which is in this particular case a November 22nd, 357.5 cover call. This is based on my income settings of short-term optimal. You can create your own settings, but based on the current market price of 339, I want to sell something that has roughly about an 80% chance of expiring worthless here. So here, as you can see, the November 22nd, 357.5 has a 79.93% chance of expiring worthless. This generates about 9.5% yield on the stock, which, if I'm paying a fifth of the cost of buying the stock, that goes from 9% to about 45% annualized yield on the stock. So that's that's how I would sell cover calls, or what we consider a poor man's cover call on Boeing leap options. Great question, Jake. Any other questions? Jake is saying, can you show one put? Sure, let's just take a bearish view on Boeing. Let's say you think this stock is going significantly lower because you think whatever is priced into this stock, and I happen to be a bit in this camp where I don't think the risk is fully baked into this particular stock price that I think that there's more fallout as we find out more things about the max. Now, I personally don't love shorting stocks on tragic events here, but for argument's sake, let's take a look at what it would look like to buy a long-term put option on Boeing. So let's say I look at December 2020. Again, I'm going to buy something that's slightly in the money. So let's say $34,000 versus $6,000 to buy this in the money put. And let's say you think the stock's going to go down to 265. As you can see here, 22% move to the downside on the stock. Now, this doesn't incorporate your margin interest, which is sometimes can eat away into your profits. Buying a put option, 64% return. So even without the margin interest, I'm looking at triple the outcome here for shorting the stock. And more importantly, if the stock doesn't move, I'm risking about $3,500, about half of what I pay for that option if the Boeing does not move any lower. But again, if the stock hasn't moved lower by, let's say, April or May, I probably would want to say, you know what, I'm probably wrong on this. You know, they're saying Max is going to come back in January. Let's say by May it's still not back and the stock hasn't moved lower. I probably would take a loss on this particular trade. As you can see, that loss is only $1,200. So out of the $34,000 that I would have risked to short 100 shares of the stock, I'm only risking about $1,200 if the stock doesn't really move. And that's a small amount of capital that in my opinion, is worth taking in exchange for if I am right and the stock does move lower, I'm looking at $4,600 profit, by May, but if it does take all the way into the year, I'm looking at $4,400. Those are the types of risk and reward that I'm looking for. So that if I'm right, I can make $4,000. If I'm wrong, I'm risking $1,200, $1,300, $1,500. Risking a fraction of what I can make if I am right on the trade. What are leap options and options table? I'm not sure what that means, Jurgen. If you can clarify, I'm happy to answer that question. Wayne is saying, sometimes when I set up a spread, the value is 250, yet the return is 100% loss. How does that happen? So the return is based on your outlook on the stock. So just because a spread has a high options play score does not mean you can't lose money, right? So if I buy a bullish spread, no matter how cheap that bullish spread is, it'll lose money if the stock goes down. Vice versa, if I trade a bearish spread, doesn't matter how great the risk reward on that bearish trade is, if the stock goes in the opposite direction that you expect it to, you will lose money. There's no such thing as an option that will always make money. So your return is based on your outlook on the stock. And if your outlook is flat out wrong, you will likely lose money. Any other questions before I sign off here for today? How can I identify leaps? They are only options, not a single leap. A leap is any option that expires greater than 9 months from today. That's it. It's just a name. It's not anything more than that. So anything that has an expiration date that's longer than, here in this particular case, the September one. So the September, December, January, these are all considered leap options. That's it. There's no difference between those options and a regular call option. We just call them long-term options. Jake, thank you so much. Lauren, how would a stock with high dividend affect your choice? So the dividend yield, 10% is pretty damn high. I certainly would reconsider buying a leap option on a 10% dividend paying stock because you probably want those dividends and you're not going to get it if you buy a call option. So I would suggest that you consider buying the stock in that event if it's that high compared to buying buying a leap. But if it's less than that, let's say it's 4 or 5%, which is still really high, like in IBM's case, right? I still think that you can make more money on the covered calls that you can sell on buying IBM at a significantly cheaper cost basis by buying a leap option. But at 10%, I think you're better off buying the stock. Lauren, does options play consider the opportunity cost of lost dividend income while holding the leap? No, it does. It does not. Which is why, again, I'm saying that on high dividend paying stocks, you may want to just own the stock instead. Any other questions before I sign off for today? If there are no other questions, again, I just want to thank everyone for taking the time out here this afternoon. I hope that you guys have found this webinar useful. It's not something that I cover very often because not a lot of, I would say, more users are generally interested in shorter term plays. But for those of you that are long-term investors, leap options are one alternative that you should consider, especially when the markets are near all-time highs and you have a higher risk of a correction. Eric is asking, do spreads make sense with options on leaps, a bull call spread? So Eric, no, it doesn't make sense to trade a bull call spread because the short leg is so long dated, you're really not taking advantage of that time decay on the short leg, which is why it makes more sense to sell a poor man's covered call. So you want to sell 1 month calls against the 1 year option that you own, because you want to buy long dated options and you want to sell short dated options. So you don't want to trade that spread. Because if you trade that spread, you're selling a 1 year option. That 1 year option is going to decay really, really slowly, and you're really not going to take advantage of that. So sell short-dated calls against a long-dated option. Do you have a list of liquid leaps? So I would say anything in the top 200 names. So any mega cap or large cap name, generally speaking, you're okay with trading leaps. Mid cap, small cap, I would stay away. Any other questions? If there are no other questions, again, I just want to thank everyone for taking the time out here this afternoon. I really, again, want to thank everyone for taking the time out here every single Thursday to come and listen to us teach you about different option strategies and how to utilize options play. I hope that you guys find this useful, and I hope that you guys consider supporting us by becoming a member by clicking on the link here in the chat window. So thank you so much. I hope you guys have a great evening. I will send out the recording with the slides in about 30 minutes from right now. So have a great afternoon, and I will see you guys next Thursday. And for those of you that are out in Vegas, I will be at the Traders Expo next Thursday. So I'll see you guys out in Vegas for those of you that will be there. So have a great evening, and I'll see you next Thursday.